Let's get back into reporting season now. Marcus Bogdan from Blackmore Capital joining me. Marcus, good to see you. I've got our good friend David Scott from StoneX joining in the interview as well. But what are some of the takeaways you've seen as we've pretty much rounded out February reporting season? What sort of report card would you give it?
I think it's definitely been a weaker report card this time around. Some of it is not surprising given the subpar growth that we're seeing in the economy, but there's certainly been pressure there on margins. It's been the sixth consecutive downgrade in commodity prices, which has been a drag. And we're seeing very mixed results even within sectors. I mean, the banks, CBA had a very, very strong result, but much softer results there from NAB and Westpac. And that just position in consumer staples, Coles and Woolworths. But the net result is that there's been a higher level of analyst downgrades for this reporting season. And it looks like we're going to have sort of 2 years of consecutive negative growth for the ASX 200.
John, good to see you, mate. It's been a while. I want to go and ask you, outside of the banks and miners, what are some of the results that have really stood out that haven't got really the same degree of attention as what we see for those really big names?
Well, I think the international industrial stocks have been really interesting, both Amcor and Brambles, and those results were pleasing. I mean, they weren't outstanding growth, but certainly in the case of Amcor, you saw a stabilisation in that business. You've seen destocking virtually finished, apart from a small area in healthcare. And you saw margin improvement and sort of a modest outlook going forward. And I think on a P of 13 times, a dividend yield of 5%, they're the sorts of companies I think you want to be sort of focused on in this environment. Brambles was also another outstanding result. Good sales revenue, good growth in EBIT and cash flow. And both of those businesses primarily are facing into the US market, and they were the two more encouraging results.
Marcus, I want to also ask you in terms of, how you sort of portfolio position when, in your view, reporting season wasn't as strong as perhaps anticipated. Where do you sort of look for potential upside as we look to the August reporting season?
Well, there's a couple of stocks where there is definitely a disconnect between the share prices and the trajectory of earnings growth. And the two stocks that really stand out for me in that sense are Cleanaway Waste Management and CSL. Both have been laggards in the market, but the trajectory and the results that were given suggest that both of those companies can deliver double-digit EBIT growth over the forecast period. They're both market leaders, and they would be two that would stand out. Probably more interested in some of the stocks that have lagged the market over the last year or so. We did take some profits in Goodman Group, which obviously has had an outstanding 12 months. But equity raisings of that level take some time to digest.
Marcus, you mentioned you were taking some money off the table. What are you doing when it comes to allocation? Are you investing that back into the market, or are you just holding back at the moment? Because you mentioned elevated valuations and the like, and the market really has traded sideways for a few months now.
Yeah, and I think the valuations on the whole are really difficult to justify given the profile of earnings growth. So you have to be highly selective. We did buy more Brambles post that result. We've added to a company called Car Group as that share price pulled back. But the net result is that we've actually added to cash, and we're holding around 12% cash now, which is at a sort of historically high levels. And I think that is just reflective of how we're seeing value and earnings growth overall for the market.
So, Marcus, you mentioned there some of the stocks that you're sort of watching: Amcor, Brambles, CSL, Cleanaway, Goodman, all kind of different sectors, if you will. If you were looking more broadly at a particular sector to outperform, where would you be looking?
Well, I think today's very interesting because one of the really big laggards, and I know I've mentioned CSL, but Ramsay has reported, and so has Medibank. We own both of those stocks. It's been a tale of two cities. Medibank has performed strongly over the last year, whilst Ramsay hasn't. But I do think there's probably a line in the sand in Ramsay in terms of its valuation, its write-downs, its new management there, the focus on returns, and also the appointment of Goldman Sachs to strategically look at the Ramsay Santé assets, which has been the real problem for Ramsay for some time. But the Australian operations, whilst they're difficult and it's been well telegraphed with Healthscope, but they did have EBIT growth there of 6%. And I do think that the premium rise that we saw from the government in terms of private health insurance at 3.7% was at the upper end. And whilst it doesn't fully negate the cost pressures that these hospitals are under, it's a very good start.